Hello, everybody, and welcome back to another episode of the Cadre Animal Health Real Estate Channel. I'm Ron Evans, coming to you from the great city of Austin, Texas. The content that we provide is brought to you by our family of commercial real estate companies, Cadre Construction and Cadre Animal Health Real Estate, Kudu Realty, Paramount Company and Floors, and Bluefin Design. Today, we are joined by my friend and colleague from Live Oak Bank. Say hi to Brei Silvia. Hello, Brei.
Hello. Thank you for having me.
Yeah, I think we're on episode 3 of our banking series. Just a quick reminder that the content that we provide here is educational, I hope. Hope it brings something of value to you. If so, consider giving us a thumbs up and subscribing to the channel. And you can reach out to us if you have questions about your project specifically, either through an email or to the website that we'll provide in the comments below. So, Brei, we've talked a lot about the types of loans that our borrowers consider, the big categories of SBA and conventional, and a few of the categories underneath SBA, the 7A and the 504. And we've talked about soft cost and people kind of getting ready and prepared for the process of having some cash available to write some checks in the early days of their project, be it civil engineering, architecture, permits, those types of things. And what I want to do now is I want to discuss the underwriting process. So it's kind of like, all right, you got to go see your doctor, and they're going to poke and probe and prod, and Brei's going to be the doctor in this. So help us understand what the process looks like, especially if it's an SBA, because I think there's a lot of fear or negative feelings about what the SBA puts you through. How does Live Oak walk you through this process? What does your team look like? What kind of information are you going to gather? And is it different just because it's an SBA? How's
Sure.
that for a big question?
That's a loaded question.
That's a big one, right?
But I like it.
Okay, good.
That's a great question. Well, I would say if you are an established practice or you're a startup, the first thing I like to do is spend 45 minutes to an hour to better understand what are you trying to accomplish? What are you trying to do? Whether you are as simple as leasing a space or you plan to do ground up construction or looking for an existing facility. Oftentimes with a veterinarian, they've had no problem with a student loan. They've had no problem acquiring a practice. Actually, they've had no problem even with a startup loan. I would say if you're going to expand your practice and enter into ground-up construction and borrow millions of dollars on a building that does not yet exist, that is a whole other ball of wax.
Yeah.
So what we like to do is we like to keep it simple. You know, banks like things on their bank forms. We do not take that approach. Our approach is really it's very personal, but it's also personable. We like to better understand where you're going, what are you trying to do, what are your goals, is your exit strategy or transition strategy? I would like to sell my practice in 5 years or 10 years. What are you trying to do? And then once we better understand that, we ask for basic financial information, which is the standard any bank will ask for: 3 years of personal tax returns, business tax returns, and a personal financial statement. At this point, we don't care if it's on our bank form or another bank's form. We just care that the information is accurate. Eventually, though, as you are expanding or even starting a practice, we will ask for business plan and projections, which oftentimes doctors don't really necessarily know what that means. So at Live Oak Bank, we ask specific questions, and how you answer those questions is your business plan. So we keep it very, very simple. It's very rare that I ask a doctor a question they don't know the answer to. They know the answer. They just don't know what we mean when we say, can you put together a business plan and projections? Right. And back to our earlier segment, we are connectors in this space. And so very few doctors have had the ability to have business classes or been in that executive role where they're understanding balance sheets and profit and loss statements and margins. And so oftentimes we can connect them to people that we've worked with specific to the veterinary space that will help them with preparing financial projections.
Well, I know that the SBA, for example, has, we're in Austin, but at the San Marcos campus in of Texas State University. Sorry, I drew a blank. They have a resource where an SBA government-provided, free to the borrower resource to help you write a business plan.
Sure.
So there's resources out there, not just the financial projections, but just the just structuring the business plan and helping, helping provide the banking, the way the bank wants to see that plan.
Absolutely.
And you guys walk them through that, and you guys help them with what you want to see and the types of projections you want. And we talked about in an earlier episode, you can then, through the SBA, loan on those projections.
And we can. And oftentimes, that's not something we initially ask for. I mean, we understand no one is going to borrow millions of dollars to maintain status quo. If you are an existing practice, the plan is there is an inherent not only risk, but a significant investment that you're making. And as a result, you expect a return on that investment. So the plan and the goal here is to grow.
Sure.
And so we dive into the projections later on. Initially, what we're looking at, if you're existing, I'm speaking in terms of an existing practice, we're looking at where your practice is today relative to where you want to go. And based on your goals, how large of a facility, number of exam rooms, any additional services you plan to provide, we really dive into what is a reasonable amount of growth, where you think your practice can grow, and how that relates to how much you can afford. Now, the big question and the big elephant in the room today is not only with budget and construction and cost, but also how do you plan to hire? What is your culture? Because we know the big issue right now within the space is hiring talent.
Right. So let's go back though, and let's talk. You said if you're an existing practice, okay, but if you're a startup, now it's focusing more on the credit worthiness of the borrower or the borrowers, and they're going to put together a business plan as well, even though they're not growing, they're starting, right? Okay.
Right. They're going to put together a business plan as well. And the key distinction or key difference is when you're a startup, you don't necessarily know who your first patient is. And we know all the AHA, AVMA data and where you should be and your profit margins and, your net income should be anywhere from 15 to 20% is the target and how much your salaries and wages should be. And that's all wonderful and great. But relatively speaking, it is the most risk. It's scary because you don't have an existing client base. And so one of the things we like to do, and it's unique to every single person, if you are a startup and you're married and your spouse is maybe gainfully employed and your spouse can support your personal living needs, it puts less pressure on the practice and your ability to have to go out and make $150,000 a year.
Right.
So we dive into much more personal conversations that are not universal to every single person you talk
Makes
to.
sense. So now let's say that you've had the conversations, you've gotten through the underwriting process, they have a business plan, and you've made a loan proposal, a term sheet. Okay. They accept that term sheet. One thing that people always want to know is how long is this term sheet good for?
Right. Well, and a term sheet is really just a term sheet.
Sure.
It's a level of interest. We obviously have a high level of interest in your project and you. We believe strongly, we at Live Oak Bank do not issue term sheets on loans that we do not think we can't get approved. So we are very, very careful about a term sheet. Every bank is different. I've seen bankers throw out a term sheet and they have hardly any information on the candidate or the borrower.
Or may not even be very interested in the loan.
Or may not be interested in the loan. And the term sheet means nothing. They actually apply with the lender to obtain approval and they get declined. We are very, very careful before we issue a term sheet. But a term sheet, once a lender or we issue a term sheet, that's because we're ready to submit this to underwriting and move forward with you getting formally approved. And that takes about 2 weeks.
Okay. And the interest rate in today's world can be locked in for how long?
So we will lock in interest rates for a period of time. We are not that 25-year fixed rate lender. I would say in today's climate, as you and I are having this conversation, prime today is more than doubled in the past 6 months.
Thanks for reminding me.
Sorry. And could potentially go up again as the Fed continues to try to control inflation. We'll see how that works. Yeah. And so I think banks are less inclined to go out for a long-term fixed rate period. There are lenders that do, but typically those lenders that do also have tighter credit parameters. Okay. In other words, you have to really fit their box.
Yeah. And in the interest rate world that we're living in, how many deals do you see pausing or just completely canceling their plans just because of interest rates? Are you seeing any of that?
I'm not seeing that because of interest rates, but I would say knowing that this was coming and just Fed printing money and the anticipation of interest rates rising and coming out of COVID and PPP and supply chain. Everyone's heard
all
that
the words
term.
that we've all learned.
We've learned in the past 2 years. I would say we've done a good job at Live Oak Bank of really increasing the project budget, increasing construction contingency. In other words, that is a money of allocation in the event there's cost overruns, or what we like to call project creep. Because most of our clients from the design phase, they're 6 to 8 months out from closing on a loan. And during this time, rates have more than doubled. Construction costs have gone up. If materials are going down, labor's going up. They are feeling compressed and squeezed at every angle. And so what we are doing is really beefing up their what we call preliminary budget so that by the time the numbers shake out, we're not in a position of having to tell the borrower, you can no longer afford this project.
Okay. But does the look, my degree is not in economics. So, these are the basics, right? 101. Doesn't it stand reason, though, that in their pro forma, if their costs have gone up, we know construction costs have gone up, we know land prices have gone up, we know that their interest rates are going up, all across the board, their inflation's hit them, but also their revenues should be going up.
Right.
And so their business plan can often match that. And they're now looking and saying, well, it's going to cost more than than I thought it was going to, right? But I still think my model, my business plan works. Are you still seeing that bullishness?
We are. In fact, I have a project here in Texas recently, about a year ago, we got them approved, provided me projections. Well, by the time that project closes, it's 2 years from the day they applied because we're looking at 12 months of construction. Yeah. So they gave me projections a year ago. They're going to close on their loan, and they're a year out from being in their building. Prior to us closing on this loan, we had them reassess their projections. Why? Because labor is up, but so are costs, so are services. Services are up. And so really the projections that were provided a year ago were stale.
Of course.
And so we revisit that because it's very important. Those are what we like to call an evolving document.
Okay. So let's close with this question. And it's kind of on topic because we're going there. We're talking about projections and revenue and inflation. You work all over the country. Mm-hmm. I primarily focus our real estate businesses in the state of Texas. Are you seeing Texas still kind of being one of those hotbeds of activity? Do you see other markets suffering more than here? What do you think about Central Texas in this region?
Central Texas is hot. Extremely hot. More people are migrating here and moving here, and we have companies relocating here, which is more dollars and more residences and more growth all across the board. I think Texas is hot. Florida is hot. Okay. California is naturally expensive, just with environmental and just their process and procedures. Most of the borrowers that I've worked with have been in major metropolitan areas. Okay. So it doesn't mean we're not working with a rural doc, but the majority of them are in metropolitan areas. I have not seen a slowdown anywhere in terms of cost.
Will you come back next year and do this interview again?
Yes, and I hopefully can tell you they've gone down, but that has not been the case.
Yeah, we're pretty bullish about the future. It's been a really tough 6 months for us in development and construction across the board. All of our vendor pricing is up, but we love this industry and we love this niche, and we think that the demand for veterinarians and their services is going to continue to grow. COVID had a negative effect, but also had a positive effect.
Well, and the data suggests it. We still are projecting, 7% growth in the space. There's just over 28,000 private practices in the United States. We have consolidators moving into the space, of course, everyone knows. And we don't see it slowing down. I mean, people still love their pets.
That's right. More now. Right. Brei, thanks. It's always good to talk to you. Let's follow up with another topic in episode 4.
Thank you.
Thanks, everybody, for listening in. We hope to hear from you soon. Please reach out if you have questions or want to talk about your real estate project. Until next time, see ya.